Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Tracy Reineck, Zacks Senior Equity Strategist, and we are talking about one of our favorite topics, Warren Buffett and Berkshire Hathaway. And Buffett, as we know, is one of the greatest and most respected investors of all time. So really looking forward to this discussion. Tracy, welcome back.
Thanks for having me. And I feel kind of nostalgic it's kind of bittersweet talking about Buffett now because he is retiring. And I'm wondering what we're going to talk about next year.
Yes. So at Berkshire's meeting in May, shareholders meeting in May, Buffett announced that he will retire at the end of this year. And Greg Abel will become the new CEO. And Berkshire shares have been behaving as if he has already retired. So I looked at the performance. They are down about 7% since the announcement. They are now up less than 6% year to date. And comparing that with the S&P 500 index, that is up almost 18% year to date. And in fact, Berkshire was performing quite well earlier this year, and shares had even surged during the tariff-related uncertainties, particularly in April. Now, we know that Buffett has led the company for over 60 years. And during this period, Berkshire shares have massively outperformed the broader market. And that's why he is known as the greatest investor of all time. Now, to discuss why they are underperforming this year, particularly last few months, whether it is due to this fading of the so-called Buffett premium or broader macroeconomic trends which are impacting Berkshire. Let's first set the stage with what Berkshire really is. So it's a huge conglomerate with market cap exceeding $1 trillion. And it holds hundreds of subsidiaries across so many sectors: insurance, energy, manufacturing, retail, railroad, financial services. And then it also has one of the world's largest stock portfolios of many publicly traded companies. And then there's the huge cash pile, which is almost $345 billion or maybe even more. So let's talk about the conglomerate. Why do you think those business areas haven't done well lately?
Well, a lot of their companies are what I call old economy. Railroads, paint, as you mentioned, energy. And these are all vital businesses, but right now they're really struggling. And I think that is starting to be priced into the stock now. And we don't really know actually what's happening with some of the smaller businesses like a Benjamin Moore, the paint business, because they don't tell us, but we can get an idea from what Sherwin-Williams and some competitors are going through, and also just what is happening in its target markets like housing. Berkshire is also big in the housing market in many other ways. They own Clayton Homes. They have a furniture retailer. None of these areas are doing well. And then they are getting hit by tariffs. We don't know the real extent of it, but in the types of businesses they have, they can't really escape it, especially if it's even in the United States and they have to buy steel or aluminum. And so that's adding on to the cost. So it's just not a good macro environment for Berkshire's underlying companies. Even on the insurance side, it's not that good right now. So when you have a situation like this where all of its businesses or most of them are not, performing very well, there just is nowhere to hide. And so I'm not surprised that the shares are underperforming. And also because the valuation was stretched earlier this year, as you were talking, when it was doing well at the beginning part of the year. It was at one of its highest valuations that I've seen in numerous years on a PE basis, at least. And even Buffett himself was not using any of his cash to buy back shares. And he said he will only buy back Berkshire when he sees a true value there. So he wasn't even seeing any value the last couple of quarters. So it's kind of a combination of things, I feel, right now. It is an earnings outlook that is not that good for the company, combined with the valuations on the shares. They're not a deal here. And then you also don't get any kind of dividend. So long-term investors are used to that. They've never gotten one, but that can help you hang on when things get a bit rocky in some companies. And right now you don't get that. And you're not going to get the Buffett premium anymore either. So it's kind of a combination of things.
Right. So earlier this week, Berkshire received a very rare sell rating. And so it was an underperform rating, actually, from KBW analysts. And they mentioned some of the factors that you talked about. They said that these falling property reinsurance prices are likely to pressure their insurance earnings, and all the trade tensions, they could impact the rail operations. And then we know that the Fed has started cutting rates. We have already received 225 basis points rate cuts, and now it remains to be seen whether they will cut again in December or probably in January. But the thing is that rates are going to be lower from here, it seems, and those lower rates are going to impact the returns on its cash holdings, because those that cash pile that is usually invested in treasury bills. So when treasury bills were earning 5%, it wasn't so bad, but at 4% or lower, that doesn't look so good. And particularly when the S&P 500 is already up over 18% year to date, right?
Yeah.
Any thoughts on the equity portfolio? So it seems that Apple, American Express, Bank of America, and Coca-Cola, these are the top equity holdings in their portfolio. And I looked at the performance of these particular stocks. So Bank of America and American Express have actually done quite well this year. Some of the big banks and financials have outperformed. So they are up about 20% year to date, and Coca-Cola is up about 13%. Apple shares have underperformed. In fact, Apple was the laggard among the Mac 7, particularly earlier this year, because Apple was seen as lagging behind in the AI race. Shares have rebounded. They have picked up recently, particularly on reports that the iPhone 17 model is seeing good sales. So any thoughts on the performance of the equity portfolio? And in fact, Buffett has been selling Apple shares and some others too. So any thoughts on the recent trades and equity portfolio in general?
Yeah, there's some people who think maybe he sold too soon on Apple and Bank of America. He's been selling that for over a year as well. But both have paused in the recent quarter. So I don't think you can necessarily time it, because there has been a pretty good performance by both of those over the time period he's been selling. But valuations did get a bit stretched on both of those. So I'm sure that had something to do with it. Yeah, I feel like there's not much you can say about the equity portfolio, because, again, that's a lot of old economy companies. He is doing decently in some of the financials, as you mentioned, because those have performed better than what people think this year. But he doesn't own a specific AI type of stock. He does have the big position in Apple still, even after selling quite a bit of it. But Apple is not really in the AI game other than using it as a product in some of its products in some way. But that may be good for them in the long haul. We don't know yet. We're waiting to see. But it is still really heavy in energy. It owns Chevron still, and it has the big position in Occidental, and energy earnings are just expected to decline double digits this year with another double digit decline for next year. So it's going to be really challenged until at least 2027. So I'm expecting those energy positions to really lag. And then Greg Abel is going to have to figure out what to do with those. They are cheap, so that's why Buffett is in them. And he likes these old dominant type of energy plays because it's kind of like the railroads now. There's only, maybe 24 big players in the energy of the like big mega cap energies like a Chevron. And so you get a bit of a monopoly type of feel. You get that moat feeling with the energies. And ultimately, it'll be fine, but you're going to struggle for the next year or two, probably. So it has its challenges, but they haven't been adding much because the overall market is just not that cheap. There is some areas I've noticed that they're buying, or they do have a position in Pool Corp, ticker POOL, and they are in pools. And that was an amazing stock up through the pandemic when everybody was staying home from vacations and, staycations were going on during the pandemic. People bought pools and in the US and Australia and other countries where they sell. But now they're not. Now that that's done and they're pulling back. So is it a deal? Pool is at 5-year lows. It's not a bad stock to be adding if you have a longer term outlook, but these are the dilemmas for all the value investors, including the Berkshire Hathaway ones. There are some equities on sale, but it might not be the bottom yet. So that's why Buffett is just sitting there with all that cash. And a lot of retail investors are as well.
Right. They haven't been doing a lot of deals lately. One of the biggest deals was they agreed to acquire Occidental's chemical business. So that is expected to close in this final quarter. And you mentioned some of the recent trades. They also added to United Health and some home builders, right? So what are your thoughts on those particular trades? They are cheap, but do they look attractive to you?
The home builders, I own Toll Brothers in Zach's value investor portfolio and my own personal portfolio. We used to be in Pulte, but we have exited that position. I don't think the home builders are a bad play right here. They are fairly cheap and their earnings have been fine and they have good balance sheets. So that's all good. But we won't really know until the spring home buying. So everybody's kind of waiting. The home builders go in these patterns where they sell off into the fall. And now as winter starts to approach, people get excited about next year. And the Fed is cutting. The rates have come down. They were at 3-year lows for the 30-year mortgage. So everybody's thinking that that'll give a boost to the housing market. But so far, the home builders in their earnings reports are saying it's not really moving the needle very much. So we're not really sure on the home builders. And so I would be a little cautious here and maybe wait to see what happens come the spring. But I still do like the home builders if you have a little bit longer outlook because they are just better run than they were in the housing bubble years 20 years ago. And they still are really cognizant of what happened during the bubble and the bust those decades ago. So they're not really repeating their bad, decisions from that era. And like I said, they have very good balance sheets now with plenty of cash. A lot of them are doing share buybacks. Their land is under control, the amount of land that they have, and they don't have, really large inventory, although some of them have said that they do want to reduce their, completed spec inventory here, but it's not like 2008, basically. So I don't mind, someone poking around in the home builders, especially if you get another sell-off and they get even cheaper. Stay with the top names, and those are like the bigger home builders, like Berkshire is in D.R. Horton. That's one of the top bigger names. On the insurance side, UNH was beaten down, so a lot of value investors did pile in there. But given everything that's kind of going on with the health insurance market right now, with the ACA marketplace, along with the discussions during the government shutdown, I'm a little leery to go in on healthcare in that area. But there are other parts of healthcare that I do like right now. The baby boomers are all over 60, so there is going to be heavy demand on healthcare in general. So I do like that area.
Makes sense. So now let's talk about the Buffett premium. And so the big question for investors now is whether Greg Abel and the other two lieutenants, Ted Weschler and Todd Combs, whether they can match Buffett's stock picking record or not. And we do not know much about them, unfortunately. We know that Abel joined Berkshire in 2000, so he has been around for a long time now. And the other two, Ted and Todd, they also joined in early 2010s. And we do know that they had encouraged Buffett to make this big investment in Apple, which has actually been his most profitable investment in Berkshire's history. So talk to us about these three and what we know about their stock picking abilities.
Well, if Buffett trusts them, then fans of Berkshire Hathaway think that they're in good hands. And we have, I'm glad you talked about how long they have been with Berkshire Hathaway. So they're not new to anyone within that organization. But we really don't know what even the two lieutenants have been doing. We know they were given a set amount of money, and then Buffett said he was not going to interfere with whatever the decisions they made, except for one time he did interfere during the pandemic when he ordered them to sell their airline stocks. They were in 4 different airline stocks at the time of the pandemic. So those were sold. But other than that, we don't know that he's ever interfered with anything else. But we also don't know what each individual lieutenant has put their money in. We just know it was, or we don't even know. We believe that certain trades were them and not Mr. Buffett. And a couple he has revealed, like Amazon, was one of the lieutenants bought that, and they're still in it today. And that's been a number of years now. 5 or 6 years ago is when they bought that. But yeah, like we don't really know anything really. And that's unnerving some people. And we don't necessarily even know who's going to be in charge of the equity part of the portfolio. Is it going to be split between all 3 of them? Is just one person going to mostly be in charge again, like Buffett was? These are all questions that are going to swirl out there once Buffett actually does retire at the end of the year. He will remain on the board, I believe, but still, yeah, these are big questions when you're talking about $350 billion that's just sitting there waiting to be deployed. So that's going to come into play. I've argued that a lot of that cash should just be distributed to the shareholders at this point. They could do multiple special dividends to reduce that cash if they can't find anything to invest it in. They could even just do special dividends on half the cash and still be sitting on plenty of firepower to get some deals if, we see a big stock market sell-off, or just, things get cheaper in certain areas next year, like energy, or even on the home side. So, yeah, I don't know. It's going to be interesting. But, that's kind of part of the fun, I guess, is that we don't really know, but the company is very well situated for whatever is going to happen.
Yeah, right. We know so little. So that's one of the main reasons why we are seeing this disappearance of the Buffett premium.
Yeah.
Now, the Journal also reported this week that Buffett will now skip writing the annual letters starting February 2026. He will still publish a Thanksgiving letter that will be on November 10th and will be addressed to his children and shareholders. That is according to the Journal. Now, those letters, we learned so much from those letters about his long-term thinking, about value investing, about staying rational during market swings, importance of quality. And then there's this annual shareholders meeting, right? It used to draw tens of thousands of fans and investors to Omaha. It is called the Woodstock of capitalism because people wanted to hear from Buffett and Munger. And now Munger has already passed away. And Buffett, we know, will not take the stage. He will not answer questions at the next shareholders meeting. So what do you think will happen to those meetings? Do you think they will still draw fans and investors, or we will not see that kind of craze for those meetings?
I'm not sure. I think the initial one will definitely still be similar to the priors, with, thousands of people showing up and the excitement of it all. But then after they see what happens without Buffett there, then I'm not sure if they're going to, book the hotels, spend the money to go all that way when the Oracle is not there. So we don't really know. It is going to be interesting next May to kind of see what happens.
Right. It would be interesting for sure. Any thoughts on the letters? Any particular key takeaways you have from his letters to shareholders?
Well, as you mentioned, they are and have always been a great source of information for value investors, or just any investors, really. Didn't they turn a bunch of them into a book? I want to say they did, like the older ones from the 60s and 70s. So they're definitely worth reading. And this last one, in this Thanksgiving letter, will, I'm sure, encapsulate a lot of just the key investing lessons he has learned over the years and that he wants to impart on us all, since this is his last one. So it will be bittersweet not to get those letters anymore, because it was kind of the old-fashioned way before social media and even, CNBC and things like that, of finding out what these great investors are thinking. And it was a good way to just kind of learn his philosophy of value investing. And he knows that, and that's why he takes them so seriously. So I'm looking forward to this Thanksgiving one. I will miss them, but I'm sure, Abel will still probably write them, but I'm not sure if, we'll have the same reaction to them. We'll see.
I agree with you, Tracy. His Thanksgiving letter, I'm sure, will be really watched and read by investors, and we will really miss his letters and his presence at the shareholders meeting, annual meetings. Now let's talk about investing like Buffett, and we know that it's not easy, but we can certainly learn from his strategies. So in the past, Buffett used to spend an undervalued company with great potential, which he called cigar butts. And later his thinking evolved to that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So one of the ETFs that I like, it is by State Street, the Spider MSCI USA Strategic Factors ETF. The ticker symbol is QUS. This invests in high quality companies with durable balance sheets and stable cash flows, which are trading at reasonable valuations. Then we know that Buffett also likes companies with economic moats, and these moats allow a company to outperform others in the same industry over time. So there's a MOAT ETF. It is by VanEck, the VanEck Morningstar White MOAT ETF. The ticker symbol is MOAT, MOAT. This invests in attractively priced companies with sustainable competitive advantages. And then he has long recommended that most investors should just stick with low cost index fund. And there's that famous bet also. And he had bet that the S&P 500 can outperform hedge funds I think that was over a period of 10 years or something like that. So looking at the S&P 500 index ETFs, the popular ones are by Vanguard. The Vanguard S&P 500 ETF, the ticker symbol is VOO. It has been massively popular, has seen huge inflows this year. And then there's the iShares Core S&P 500 ETF. The ticker symbol is IVV. IVV and VOO, they charge just 3 basis points each. But the cheapest S&P 500 ETF now is by State Street. The ticker symbol is SPLG. That charges just 2 basis points. And lately, we have seen a surge and launch of these derivative option income ETFs. So there's obviously a one tracking Berkshire Hathaway's portfolio as well. And the ticker symbol is OMAH. It is by Vista Shares. So this invests in a narrow portfolio of securities which are selected from Berkshire's positions and then uses covered call options to generate income. Now, I've talked about option-based income ETFs, and I'm not a huge fan. So when stocks are doing well, these ETFs underperform their underlying security, the security that they track. But since this ETF launched, Berkshire shares have been underperforming. And in fact, since the launch of this ETF, Berkshire is down about 4%. This made its debut in March, and because of its option income strategies, the total return on this ETF is about 4.6%. So it has neatly outperformed Berkshire shares, and that is mainly because shares are down. So investors should remember that when Berkshire shares are going to do well, the ETF is going to underperform. Any other closing thoughts, Tracy?
Yeah, I just wanted to add a little tidbit about buying the S&P 500.
Sure.
But Buffett has said in the past that if he passes before his wife, he's instructed that and the inheritance and the money he's leaving her be invested in the S&P 500, and that's it. So that's how much he believes in just buying the index.
Yeah. He was a big fan of Jack Bogle.
Yeah.
Okay. We'll have to leave it there, Tracy. Thank you so much for joining us today and for sharing all your insights. Tracy hosts the popular Market Edge and Value Investor podcast, so definitely check them out and subscribe. Now let's quickly recap some of the stock and ETF tickers that we discussed. So Tracy mentioned Pool, the ticker symbol is POOL. Occidental, the ticker symbol is OXY. We talked about Apple. We know that ticker symbol is AAPL. Bank of America, BAC. And we discussed S&P 500 ETFs. The ticker symbols are IVV, VOO, and SPLG. And we also talked about the MOAT ETF. The ticker symbol is MOAT, MOAT. And the quality ETF, the ticker symbol is QUS. And finally, the option income ETF, the ticker symbol is OMAH. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.